we start with Mike, because Mike's going to slip away at the very end. Mike will tell us about the company that he thinks is in a good place at the moment and worth a bit of research.
Thank you. We might well be hearing from more interesting and exciting companies than this one, but I think that in certain times it's preservation of capital that's important, and also the tax angle is important as well. So the one that I would mention is one that's floated in the past couple of weeks, and it's floated on the basis that it's kind of broken one of the golden rules, step one, in that the vendor is venture capital house, and obviously investors tend not to like this because they feel the VC has invested money in these assets. It's freehold real estate backed to make them return very well, be a quality company. What can happen from here once the VC is looking to sell it? It's going to be a bit more boring, or a bit more, something's going to come out of the woodwork. And actually, I would invest in this one, which is Elegant Hotels, because it is actually fairly straightforward and easy to analyse, and has had a lot of the hard work in increasing room rates and getting good returns done. But I think it's also very resilient. So Elegant Hotels is 5 freehold hotels, 4 and 5 star in Barbados. They're the market leader, but not dominating the market. So they have got certainly knowledge about local market and pricing. The returns that are being got are because this venture capital house that owned it, that took them private in 2010, has invested quite well in them, and at a time when the market has been going sort of sideways, room rates certainly have gone up. But the point is that we're buying this for security, and so if we look at the Barbados market, it might feel as if it's all sort of very exciting and a nice place to go to and a bit tropical. But actually, if you look at the past 20 years and look at the downturns in those past 20 years, whether it's the Twin Towers or the 90s or more recently, the fall in visitor levels that you've seen to Barbados is never been worse than the high teens from peak to trough, not in 1 year, peak to trough. So in a way it's not surprising that room rates hardly really went down significantly. And okay, you got discounts from the likes of Sandals and so forth, who are competitors to Elegant Hotels, but they are the secondary player. So you've got freehold quality assets in a market where the demand has only literally just started rising this season. You've got hotel assets that are well invested, where you have seen increases in prices of 5 to 7% for each of the past sort of 4 or 5 years. It's returning about 9% post-tax on assets, which isn't fantastic, but it's a very solid return. It's all cash backed because they have invested strongly. The proceeds of the fundraise means that you've got about 20% loan to value. So it's taking a very sensible and cautious view that they are hotels, so you don't exactly want to have 80-90% LTVs. So the cash back returns means that the 7% dividend yield, okay, it's progressive dividend from prospective as well, because they've only just started being floated. But I think we can be pretty sure they are going to pay that sort of yield. That's 1.5 times covered plus by cash, and it is actually qualifying for IHT relief. So if you put it in a vehicle where you're going to get that yield tax-free, and it qualifies for IHT relief, and it's in a market that is pretty resilient, and it's well invested freehold assets that don't dominate but lead the market, I think that it's pretty secure. The one final point I'd make is that the market is very well aware that there's still a 25%, 24% holding by the VC in there. They said they stay in for a year, so that means they're probably looking to get out in a year. The market is very well aware of that. The other leading shareholders, the likes of Artemis, Miton, Fidelity. So there's some very good names that come in there. I don't think the price is going to go up 30-40% straight away, but it's very secure.
Okay, I've got a couple of stocks. At the risk of being accused of being Mr. Bioventix, I decided to prepare something other than Bioventix. But I will just give you a very quick update. If you just look at the first page of Bioventix, the last 3 bullet points there, EPS grew by 32% in H1, and FinCap have just updated or upgraded their EPS forecast from around 41p for the whole year to 44.8p for the current year. However, to achieve that target, Bioventix would only have to grow revenues in H2 by 5%. Now, there's a new vitamin D antibody that's just come onto the market with a partner company called Beckman Coulter that came on in January 15. Those of you know it well, this is an annuity type stock that receives royalties. It's almost impossible for revenues to only grow by 5% in H2. So I'm penciling in a significantly higher number, as you can see. And if you look at historic forecasting by FinCap, they've always underestimated EPS growth at Bioventix. So certainly something to watch out for. And if you can get the FinCap note on Bioventix, the one that came out in May 15, something that took me by surprise was this line, revenues from this one test, troponin, it's a high sensitivity test, again being introduced by Beckman Coulter, we believe in 2017-18, could grow to dwarf the current business. And that took me by surprise, and I'm not often taken by surprise. Plenty of graphs to support the investment case following on that, but I don't want to dwell on that too much because I know you think I've only got one idea. So I've been scrambling for another idea, and one popped up a few weeks ago, a solicitor's firm called Gately. It's the first full-service solicitor's firm to come to the market. There are public companies with legal practices specialising often in no-fault claims such as Reddy, and of course we know about Quindell, but this is a full-service solicitor's firm. They came to market last week at 95p, 100 million market cap at the IPO. They raised net of fees a modest 3.8 million, and the existing partners took out 26.3 million. 100 partners. They're a mid-sized firm. I've worked with them in my professional life. You'd call them solid rather than dynamic, but they've been growing at 14% per annum for the last 10 years, although rates in the last 3 or 4 years have been at a level lower than that. If you look at the second page there, the forecast revenues for this year are 60.2 million, and the forecasting profit before tax of around 10 million, and that's expected to rise to 70 million in the year following, with an increase of 25% in profit before tax to 12.5 million. You know, I'm a big fan on measures of return on capital and return on assets. In this case, I've looked at the EBITDA to total asset ratio. It's a capital-light business, as you expect for a business that where the partners sell their time and the other fee earners. They generate a 28.7% return, or are expected to generate a near 30% return on total assets in the year 16. Fully diluted EPS for the current year, which will really represent what the partnership, the limited liability partnership, was doing, was around 7.5p with no dividend. That's ending, I believe, in April, so that's April 15, so we're already past their year end. Current year forecasts are for 8.4p, rising to 8.9p, current PER of just 13.2, dropping to 11.2. Key thing for me is the payout ratio. That tells me a company's ability to generate free cash flow. So forget earnings, this is the ability to be able to generate cash from those earnings at 70%, actually even better than Bioventix. I'm going to be complaining to them bitterly shortly. The dividend yield that throws out is 5.9, rising to 6.2. Now, it's not all great. I mean, there's some positives. They've got a new office in Leeds that's growing organically, just 25 fee earners there. That's expected to do well. And they're looking at acquisitions, but largely of businesses tangential to core legal services. They have first mover advantage. They are the first legal firm to take this route, and that might be aid growth. One of the worries I've got is that the staff share of revenues, if you include partners, fee earners and non-fee earners, is planned to drop from around 73% to just 60%. And the question, of course, is how viable that is in the medium to long term. Partners' salaries have been fixed at 131,000 for the current year, but that will be paid all in cash versus historically partners' profit share, which averaged around 225,000. But a lot of that was retained within the business to fund working capital. But nonetheless, partners had a claim on that when they eventually left the partnership. Partners do have a 5-year lock-in period, which is very important. And there's some issues with work in progress. Anyone who looked at Quindale will know this is always a worry in these kinds of firms trying to estimate that. I mean, this is a kosher legal firm. I'm sure they won't be pushing the boat too far out on WIP. But clearly, as the business grows, you're gathering more WIP and more debtors. That is always a drag on cash flow. And there has been some downward pressure on fees in some of the regional cities, although Gately don't seem to have been unduly impacted by it. So for me, it's very much a work in progress still. I'm still keen to meet management there, understand how they're going to satisfy future partners of the firm and whether they're going to be able to provide them with sufficient benefit to offset the decline in the share of the profits. What I haven't added in here is the dividends that they'll be getting. So dividends for the largest partners, the larger partners with a larger equity interest, will be close to 240,000 a year. So that would be more than make up for any loss in the partner's share. And the average amount of equity each partner owns is about £1 million. So that would be throwing off about 50 or 60,000 of dividends a year. So, but we are still a bit short of where we were on what partner profits were before, and that extra bit has been squeezed out to benefit us potentially as shareholders. Certainly one to watch and one to possibly get along to a Mello and quiz the senior partners on what the growth strategy is for the company.
The couple of stocks that I think are extremely cheap at the moment, if you are a value player, are a couple of the private equity investment trusts. And I've been a long-term holder of something called Graphite Enterprise Trust, which has got a fantastic long-term track record. What tends to happen with these investment trusts, particularly in sort of niche sectors, is they tend to slightly go out of fashion. And while they're out of fashion, the discount widens. And Graphite, I think, is on about 25% discount, something of that order. And the other one that I've got is called Dunedin Enterprise Trust, and that's on something like a 35% discount at the moment. Now, the reason why that's particularly significant is at this point in the cycle, quite a lot of these private equity funds are actually in a kind of realization mode, i.e. the investments they made 5, 6, 7, 8 years ago are beginning to mature. And so the expectation is they'll start to sell them off. And both the chairman's statements of those two investment trusts for their recent results said that they had significant potential uplifts in the valuations within the portfolio from maturing investments, which wasn't already recognised in the asset values. So you've got a potential, obviously, that effectively the discounts are getting even wider, even more ridiculous, once they start selling those individual businesses off. And the point of the economic cycle that we're in is likely to mean that there will be more M&A, i.e. there will be the buyers for those businesses within the portfolio that the private equity boys want to sell. And the likelihood is that there will be more competition for those businesses, and therefore the valuations potentially will be attractive. So I think those are two stocks, Dunedin Enterprise and Graphite Enterprise Investment Trusts, where we could see re-ratings just from a narrowing of the discounts, and then obviously from the realisation strategies taking place.
Thank you, Reg. Bit of variety for us there. Now, I'm going to give you a small cap. It will be one that you've probably heard of before. I know in the room here we've got at least 5 holders. They're a company who came to our Mello event in Derby. And it was 2 ladies who presented, and it's a company called 1PM. OPM is the ticker. Now, I won't go through all the metrics, but there are a lot of things that you can find out about 1PM from the information they give out regularly in their trading updates. They did a trading update on Thursday last week, and they said that their revenues were slightly ahead, but their profits were substantially ahead. And for one reason they gave, but there are other reasons, I'm sure. One reason was that their bad debt provisioning wasn't needed at the extent that they thought it would be. They've got much lower bad debts, and the general tone of the announcement was that things are clearly getting much better for them since their office move, because they were restrained in the past because they were in very small offices. They only employ, I think, 14 people, or did in the offices that they had. There are lots of companies in the sector, but most of them have got much higher expenses than 1PM. 1PM we're in a very low cost area. I don't see why anybody that's lending money to businesses and for equipment needs to be in the centre of London. That's just high office costs and low profits. So 1PM we're in a good space. They lend money efficiently, very low cost, low bad debts, and they're making higher and higher profits from it. And so as they expand the business, they bring in more and more revenues. The costs don't expand at the same rate, so the profits become much, much higher. They're very operationally geared, and they're doing a great job. They're very well run. As I say, the bad debts are going down, and if you can imagine, if you had £10 to lend to 10 people, if you were getting, well, they get, I think, about 17% return on some of this money that they loan, but if you were getting just 10%, you only need one person not to give you the money back, and you've actually only got the same money that you started with. So you really do want to make sure you keep your debts, bad debts down, and that's what they do. And every announcement they make, they're going lower and lower, almost down to nothing, so that's fantastic. Anyway, it's 1PM. If you check the announcements, you'll see the way it's going. The forecasts that are out there are way under. And I spoke to the analyst. We mentioned earlier about ringing the company, ringing up brokers, PR. I actually rang the analyst that did the note for 1PM. And he's quite a good guy. I've known him for years. He said, I haven't actually looked at the figures for next year yet. I won't do it until the results are out this year. So in actual fact, you're seeing unchanged forecasts for the current year because they've already ended. They gave a trading update for the end of the prior year. So we're into the current year, and there's no accurate forecasts, in my opinion, that are out for this current year. So you're going to see those go up substantially because they are in a very good space at 1PM. And they'll probably last another 2 years, maybe longer, as the economy lifts and people do more and more with their businesses. They need to borrow more money to expand the businesses. It's great for 1PM. They're getting a lot of business. They've got a lot of money now to loan out, because a lot of people have been chasing 1PM to get 6% return on their money because they borrow it off individuals and off companies. And they're in a good space loaning out. They get the difference between the 6% and the 17%. That's a big figure. So they're doing very well. I think they're a good company. I think next 2 years you'll see at least £1 per share, and at the moment they're 70p or 69p. Could go a lot higher than that, but I'll be amazed if they don't get to £1 and you can hold them to that. Anyway, there you go. So we've had a good range of companies, a good talk tonight. I think it's deserving of a fine round of applause for our panellists. Thank you.